Welcome to This is Property. You're here with John and Rachel. We have seen a lot of things happen in the market in the last few months, and we thought we'd put some questions out there for a Q&A this week.
Absolutely, yeah. Do you know one of those things, Rach, just before I jump in? Australian real estate has reached a value of 11.8 trillion as of last week.
11.8 trillion.
Makes it the largest asset class in Australia, and it's actually higher than the combined superannuation, ASX and commercial real estate. That's worth 9.1 trillion. Out of control.
That is phenomenal. Every aggregator, which is in mortgage broking land, also said last month was their biggest month in lodgements ever. So everything is definitely moving in a pretty big way.
Yes, absolutely. Especially if those aggregators have been around for
a long time.
Yeah.
So let's get into the show.
Let's do this.
So we asked the Facebook group for some questions and you've definitely delivered. I'm going to throw the first one out there. Sam says, spend money on home improvements first or invest first. Will the equity increase release after home improvements allow for a better investment property purchase at a higher price point? Or will the market move so much in a year that it will make home improvement equity kind of pointless? Looking to renovate bathroom, kitchen, redo deck and spray the roof, some landscaping. But if we went for an investment property at current borrowing capacity, we would be maxed out. Not sure how renovations are judged by valuers. And that's a pretty common question at the moment. Upsize or renovate or invest. What are you seeing in the market, John?
There's a few little bits to unpack here from Sam. So generally speaking, as soon as I hear that, I think, what have I done? And I've always gone invest first. Yeah. And I'm like, improvements later, because I can improve that place at any stage in its journey. Investing is now, because otherwise there's an opportunity cost potentially gone missing if I buy well. In saying that, I get the whole spend max out at 450. What can we buy around the country? That's real for sure. The other part of it is valuations. Like valuations are going crazy right now. I spoke to a client yesterday. He bought settled 3 months ago for 815. It's now valued by another lender at 870.
Wow.
3 months. Now, being in the game, that usually valuers will say, or banks will say, it's less than 6 months since we settled. We're going to value it on purchase price.
Yeah.
It's crazy, isn't it? So
it is absolutely crazy. On that same point, we had a client buy 6 months ago at a 90% lend, and it was a big question for them. And you and I have talked about this a lot. Do you pay the high interest rate at 90? Or do I put the 20% in and go to 80? And they opted to go to the 90 with the higher rate. They've already got a valuation to get the lower rate.
Back to 80%.
Very happy they kept their cash out to be able to go again.
Yeah, cash
but
is
it's
king.
moved quickly.
Yeah, absolutely. So we're not in what we would say normal times.
It's not.
It's a bit unprecedented to some extent in the sense that all markets around the country are pretty busy. But in terms of renovation, what I think we ideally want to, if we're spending $1, we want to get at least $2, if not $3 back on that, right? So it's strategic improvements that you're almost putting the makeup on so that someone thinks, yeah, wow, that looks amazing.
Yeah.
Really just, because you're not doing it you're doing it with your business hat on, saying, if I do this, I'm going to get this result, which allows me to go and do X.
Yeah.
So what are you doing? Are you home improvement or are you investing?
Knowing that you can't do both and knowing that buying this investment property now would max out, so it's not equity you're short on, you're saying it will max out your borrowing capacity. So income-wise, you probably won't be able to do this renovation if you buy this investment property.
Yeah.
But also, if you do this renovation, no matter how much equity you build, you're not going to have the income to buy the investment property.
That's a very good point.
So if I was choosing, I'd choose the investment property.
Yeah.
Because I would think that would give me more return in the long run, hoping that I can do my renovations a little down the track.
Yeah, and I was always told, like back in the day, that the outside improves the value, the inside improves the yield. But I think it's definitely a combination of both. And Sam's looking at the bathroom and kitchen, absolutely important. You can visually see there's some value there. And yes, that improves the yield, but the value will increase. The deck, the balustrades and the roof being sprayed and the landscaping, that's all going to increase value. So the focus on certain areas for improving the value is definitely there.
Yeah. And to answer Sam's question, I know you've been, servicing might be your restriction, but you did ask how our valuers judge renovations. What they do is they look at the renovations that you've done and they say, well, this house now, what would it sell for in the current market? So, you might put a pool in and spend $100,000, but that might not add $100,000 to the sale value. No. At the moment, I think they are. I think the valuers are saying the pools are pretty sought after. But traditionally, it was $100,000 for a pool, $60,000 in valuation. Yeah. So it doesn't always add that, but you want the pool, so you put it in.
Yeah, well, that's it. And I'm sure I've said this on the show before, but my pool cost me $200,000 because the valuer came out and said, well, this block can't be subdivided anymore because you put the pool in. Right now, again, when it's your own home, there's no development potential. We don't want to develop it, right? But from an investor point of view, you've got to be thinking about what people want and also what valuers are thinking.
Would the Pigeon kids say that was worth it? I
think they're pretty happy with it. And mum and dad are pretty happy as well because it's a bit of a babysitter on board, isn't it?
Yeah.
So on the valuation piece, there's the bank valuation and there's an independent valuation.
Yeah.
And there's a desktop valuation and there's a curbside valuation. So talk to us maybe a little bit before we go on to the next question about, as a mortgage broker, where you go to first.
Yeah, so it's been like playing a game of Guess Who the last month, to tell you the truth, because people are wanting to move, investors especially are wanting to move at the moment. Everyone is doing a lot. And valuations are a big thing. So what the valuation is can really impact. So we've had so many, like where a desktop might come in $50,000 more in one transaction, but then in another, the full valuation came $100,000 more.
Wow.
So it really isn't what's coming in better. It's about, for that particular client, what is the most fortuitous road to take.
Yeah. So as a general rule of thumb, would you say if internally looks better than the norm, you want a full valuation because you want them to go through and experience that new standard of living inside?
If you've done renovations, generally you want a full valuation, but I've seen some desktops come through that have blown my mind lately.
In a good way?
In a good way, but then there's also, I guess there's some risk in that it may not actually sell for that. So you need to have, it depends what your purpose is of that valuation, right?
Okay, I'm going to extend that. If you saw a desktop val that was high, as in no way that's going to sell for that, the purpose of the valuation for the investor is to get equity out of that property.
Sometimes, but sometimes the purpose of that valuation is to negotiate rate.
Okay.
Sometimes we're going, okay, now it's a 60% LVR, loan to value, we can get this rate because we got this really cool val.
Yeah.
So, but sometimes, yes, it is getting equity out. And a lot of investors think to take it out when you can.
Me included. Very good. Okay. Good question, Sam. Sam's actually got another one. We've given Sam some airtime here. In light of recent ASIC licence cancellations of a well-known BA, what to ask a BA before you commit, red flags and green flags? We've definitely spoken about this a fair bit on the show in recent times. So, go back and check previous episodes on that. But I'll maybe ask you, Rach, what would you ask of a BA if you were using or looking to use one?
Yeah, I'd probably want to know, are they going to inspect the property right now themselves? That's a big one for me.
Wow.
And I've used a BA once, to be like full disclosure. I've only used a BA once, but I had never been to the area that I bought in. So it was really important to me that they had the knowledge of that area because I didn't.
Yep.
But I'd want to know local relationships. What are they like?
With agents?
With agents,
Yep.
and I'd want to know how well they know the area that they're going to inspect the property. I'd also want to know if they were, and this is maybe a personal opinion, not a professional one, but personally, I wouldn't want somebody who didn't have their own property portfolio buying a property for me. I think there's a lot of people in the industry right now that probably don't have the experience that I would expect.
Yeah, that's probably the biggest one at the minute in today's world, along with the first one that you mentioned of not inspecting properties.
Yeah.
Like that is a non-negotiable. You've got to have someone look through that property and kick the tyres and lift up mats and open doors and turn ovens on and just be on the ground. Like that's absolutely a non-negotiable. The one about, I suppose, having the experience as an investor, we're big on. Like we're always employing someone as a BA or anyone that's in our business really that has investment properties and can live and breathe what we're doing for the clients, because there's no better way to get experience than to do it yourself, is it? I would also ask how long we've been around as well. There's a lot of BAs that have been here 5 minutes, so they haven't seen. Why is that important? People might be thinking, well, they haven't seen true market volatility and they haven't seen trends over a longer period. And you can research that, but it's very different to being in it and experiencing it at the time.
Yeah. What would the red flag be for you?
I think you've mentioned my main red flags and full disclosure, obviously running a buyer's agent service, but also being passionate about coaching and education. Like I couldn't care less if someone used our BA service or went and did it themselves. I'm actually quite passionate about someone going and doing it themselves, and that's what we built early on, was this education program. But I think, they're the key ones for me. The other, I suppose the other one that's maybe not as important, but like, who am I going to be dealing with? Like, what's your staff look like? Have you got a dedicated BA that covers certain areas, or do you have who's going to be doing my strategy? Like, if I'm a one-stop shop where, Rachel, you're doing the strategy and you're also doing the searching and you're also doing the admin, right? You haven't got time for many clients, so have the ability to have that, I suppose, client customer service.
Yeah, and maybe get their service proposition up front.
Maybe, yeah. And just some history on what's a typical property they've found. Like, show me, as someone in my situation, I want to spend $600,000. I don't know, what have you got for me? What properties have you bought on behalf of clients in the past that may be similar to my scenario, sort of thing?
Yeah. Paul asks, is it wise to buy an investment property with cash?
Yeah, good question, Paul. Very limited in its content. I suppose we'd want to know from Paul whether we need that cash for anything else.
Yeah, look, I would say if I've never bought an investment property with cash.
Never?
But let's say Paul had the cash to buy an investment property, had the cash sitting there and could buy it in cash, and maybe had no owner-occupied like if you have an owner-occupied mortgage, the answer is absolutely no, because you'd pay your owner-occupied. But I'm just going to play devil's advocate and say you've got no owner-occupied, you've got the cash to buy an investment property sitting in the bank. Would I buy it with cash? I wouldn't. But what I would do if I had the ability to and nothing else to do with that cash, let's say it was $500,000, I would borrow 80% of the value of that, and I would park 80% of the value of that in an offset account. So I'd pay nothing on the interest, but I'd always have the ability to take that cash out if I wanted it.
Yeah, you're keeping fluid.
Yeah.
So I feel it's, I suppose, a question that's, it has so many spins to it. But like, Paul, I'm with Rach. If you've got equity, just go and use equity. Like, there's no reason as to why you would use cash. Your repayments are going to be less if you use cash. I get that. But so are your opportunities to do other things later, like pay down the mortgage further or invest in shares
100%.
Or go on holidays or whatever. You've got to be cash heavy in this world.
And I've got many investors that are at a nil position, as in they've got maybe $1 million in lending, but they've actually got $1 million sitting in offset. So there's a lot of investors I have out there that are not paying any interest right now. Very sad for me. No interest being paid. But if they wanted to draw those funds down the track and use them, they could.
Yeah.
Now, I know there's been a little bit of chatter mainly on the socials about offsets not getting linked and the banks are out to get you. I've done this for 20 years. I've never seen that happen intentionally by the bank. What I have seen is a broker or a banker not link it correctly, and I've never seen a case where the bank hasn't gone back and paid that if they've made a mistake. So, you know, I think offsets getting that, people saying, oh, banks are out to get you, they're not linking. Like I've said, I just make sure it's linked. Check it online.
Yeah.
But yes, offset would be my strategy if I had the cash.
Yeah. They're not out to get you. They're just sometimes incompetent.
Yeah.
That'd be fair to say.
You got to check.
Yeah, absolutely. The only exception, Paul, I suppose, is I'm working with a client who's probably 10 years from retirement.
Okay.
Right now, and he's looking to buy an investment property with his son, which is pretty cool. And we're seeing more of that because son needs to get into the market sooner rather than later and might not have the servicing, right? So he's got to be mindful that we don't want to pull too much equity from his portfolio because he's got retirement pending in 10 years' time.
Yes.
So in that case, it might be just a little bit of balance. Put some cash down, but you also want to be cash heavy in retirement as well. So it's a bit of a balance there to figure out what's my loan to value ratio, what are my repayments going to be in 10 years when I retire, and do some forecasting.
Yeah, and your accountant might be someone to go and have a chat to about that too.
Absolutely. Yeah.
Well, we might take a break, and when we come back, I've got a question for an ex-farmer.
Ooh.
This is Property is brought to you by Sphere Home Loans. Sphere Home Loans is a mortgage broker that helps our listeners all around Australia. So, if you want to get into your first home sooner, looking at upgrading, an additional property, or want your current mortgage reviewed, just search Sphere Home Loans or click the link in the show notes, and their dedicated brokers will be able to help you wherever you are. If you are, however, after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to moneypodcast.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. That's moneypodcast.com.au and click Get Help.
Right. Is someone about to walk through the door, are they?
No, I was just checking out the time.
No, when you said ex-farmer.
Oh, it's you.
Yeah, it's me.
It's you.
Right, okay. Yeah, look, these hands are far from farming at the moment, but yes, we did do a little bit back in the day. I keep in touch with my brother on a daily basis. So your
brother runs the farm?
He does.
Yeah, nice.
So I still feel as though I've got some sheep in the brains, and any case. Megan
says, what is the best tax structure to buy a working farm over 20 hectare? SMSF, company, private names, no intention of leaving it to the kids. It's just not their thing.
Yeah, so we're not going to be able to answer this question properly, really, Megan. It's going to be for an accountant to look at your overall situation, isn't it? The fact that we're not leaving it to kids changes the method for sure. When we're talking about, I suppose, buying entity, we're not just talking about tax structure, are we? We're talking about asset protection. We're talking about lending. For example, what's your I suppose history at the moment of buying in a company versus private names? Is lending harder? Is it more complicated? Is there more paperwork?
We see a bit of company and trust buying an SMSF. It changes a few little things, but really, as long as you've got the servicing and the deposit, you can buy in any entity that you want.
Yeah,
it just might be different banks that you choose based on who does that.
Different lenders, so that's something to reach out. But there's more paperwork involved.
It's definitely more paperwork. You've got to, pay your accountant to set up those structures and all of that other things, but it depends on your why.
Yeah, absolutely. And that's where I was going with for Megan is, well, what is your why? Like, you're wanting something over 20 hectares, so you've got to take into account stamp duty. You've got to take into account tax benefits, income derived from that, and what your income's going to be like, because that has a whole bit to play when you're talking about distribution.
Yeah.
Now, no kids or not leaving
Not
it to kids.
passing
I'm
it
not
on,
sure
yeah.
if the kids are there or not, but let's say the kids are there. Once they turn 18, there's the ability to distribute income.
Yeah.
So that's got to be taken into account. The fact that it's not going or leaving it to them is needs to be factored in. But yeah, financial advice. Talk to your accountant about that.
Yeah, and I've seen accountants model it out for clients. So, they've been umming and ahhing about trust, company or personal name, and the accountants have actually done a model for each way of what that looks like
which is
for
great.
them. So
It's
I think
like a
you've just got to
table.
get it modelled out.
Yeah, absolutely. But yeah, good luck, Megan. 20
Yeah.
hectares. Enjoy the space.
Absolutely.
Stephanie says, given the recent 5% deposit changes and therefore possibly a lot more buyers in the market, have I missed the boat to buy my first investment property? Is there a sweet spot purchase price wise that will help to? Is there a sweet spot purchase price that will help to target? Looking for capital growth to sell in 5 to 10 years and upsize PPOR. Thanks, Brain Trust. Rach.
Yeah, that's a tough one. Stephanie, I think the market is pretty hot right now, but that doesn't mean that it's not the time to buy. It just means what is your strategy? And I think when people can buy, they tend to buy in the market that they're in. But it is pretty hot. What do you think?
Well, look, I think if you're in a position to buy, you're buying.
Yeah.
If that's in your mind, that's what you want to do, and you can lend money, why aren't we buying? Like, we missed the boat because we should have invested in 1982. Like, we've all missed the boat. Every day we miss the boat, don't we?
Yeah.
So we can't use that as not an excuse, but a reason not to go and do something. We've just got to look at it and say it's there for the long term. Now, if you're wanting to get your money back out in 5 years, I'd be concerned.
Yeah, and it was the 5 years that made me go, ooh, because it is important to note, and especially for investors that haven't invested longer than 5 years, we've had a pretty cool 5-year run, and I just think it's important to note that doesn't always happen.
No, that's right. And Sydney and Melbourne have been a little bit of an exception for that last 5 years as well, weirdly enough, because they're the two largest capital cities. But I think, I don't think you can, because of the rigid costs of purchasing and selling in real estate, I wouldn't be doing 5-year plans.
To rip out and update, because the goal looks like it's to update owner-occupied.
Yeah, upsize. Yeah, so you've got to then say, well, okay, by the time, if I go on, say, 7% growth per year for the next 5 years, right, what's my property value going to be? That all looks rosy. Then I take off my stamp duty, I take off my selling costs, I take off my capital gains, and maybe the money I've put in from a holding cost perspective, whatever that might be. What's my net outcome?
Yeah.
Right? 10 years is fine. 5 years, borderline.
Yeah, and I spoke to somebody a few days ago that said, what if I buy today and then it's worth, and they were looking at the 700,000 mark. What happens if it pulls back next year? There was some predictions of what if it pulls back and it's only worth 670 next year? Yeah. And I said, that's absolutely can happen, and it happens in property, but are you going to sell it next year?
Yeah.
If their goal was to hold for the next 20 years, well, then it doesn't matter if it pulls back next year.
Yeah, that's right.
And you don't have a crystal ball to buy it next year.
No. And I'm sure your phone's gone off the hook after our recent episode on the boom bust cycle as well. So that's
absolutely. Lesty asks, what's going on with the Melbourne property market, especially sub 1 million with the latest government scheme? That is in your wheelhouse, Glenn. John?
Yeah, well, it's what did you call me?
I called you Glenn.
Oh, Glenn. Yes, it's heating right up.
Yeah.
Yeah. So as I said before, Melbourne property markets hasn't been great prior to probably the last 12 months, but yeah, now it's really creating some steam, and sub 1 million is that sweet spot for first home buyers and even investors that are seeing real opportunity. And I feel like a broken record being, in Victoria, government's terrible, stamp duty's higher, land taxes there, blah, blah, blah. But the opportunity is there because of the value for money compared to other capital cities.
I've seen a huge amount of investors buy in Victoria in the last 1 month.
1 month, yeah. Well, and they're competing against first home buyers, and which aren't getting the stamp duty concessions. They're not too fussed about that. They're fussed about, okay, I can put in a 5% deposit and I'll manage the repayments. I'll take care of it and live in it. But yeah, I think there's in short, Lesty, it is going off.
Do you think it's still good buying there?
Melbourne, generally, I think it's great buying in specific pockets. Yeah, I don't think it's a blanket, let's just go and buy in Melbourne. Pockets to the west don't excite me too much. But, yeah, there are definite pockets where we think, wow, we've got to get in yesterday.
Yeah.
And again, like sub-million, that's a wide variance as well. So what you're buying at 900, 950 is very different than what you can buy at 750, 800.
Yeah, okay.
And also, as we always talk about, the asset class in which you're buying.
Yeah.
Yeah. So, yeah. Take of that what you will, Lesty. Angela, how much spare cash do you need for it to be feasible to purchase an investment property? Now, you guys at Sphere Home Loans, Rach, do this all the time in terms of how much it's going to cost someone to loan some money on a monthly basis.
And I think the borrowing capacity, so to buy an investment property, Angela, you need two things. You need the sufficient equity or deposit, and you need the ability to borrow, so the servicing capacity. But they're very different things to affordability. So just because you can afford to buy an investment property on the bank servicing calculator doesn't mean that an investment property is going to fit your family's budget. It doesn't mean that that's right for you. And I think a lot of people, when they see what that investment property that they're looking at is going to cost to hold them every week, they really need to consider whether that's right for them. And, it's a regular thing at the moment that, we're looking at properties that are, $200 a week to hold when people are doing their figures. You go, is that right for me?
Yeah.
Or do you have $200 a week spare and a little bit extra in case something goes wrong? Are you going to have extra buffers put in place in case you need repairs? And I think that if a lot of people, I think, look at what that property is going to cost you, and every property is going to be different depending on the asset that you buy. But you'd really want to make sure that you've got that spare cash that property is going to cost you available, and it's not going to change your lifestyle.
Yeah, absolutely. It's you don't want to put yourself in a position where you have to sell the property.
No.
Is basically what we're saying, Angela. So, yeah, the interest to the bank is one thing. But the running costs are another thing. So there might be some land tax, there might be some strata costs, there will be council rates, there will be insurance.
Property insurance has gone up
management.
30%.
Yeah, it has. So you really need to dot the I's and cross the T's on that one because, and again, case in point, I did a strategy with a client this week where I said, well, okay, how much can you First question, how much are you saving each month?
Yeah.
And they're like, between $600 to $800 per month. Okay, cool. How much can you deploy to this investment property per month on an ongoing basis? Probably about $1,500 to $2,000. I'm like, okay, how can this be happening? If you're only saving that amount, where's the $1,500 to $2,000? So we had to go back and forth and just strip things apart a bit. So the key question here is, Angela, how much have you actually got? Not what's on paper here. Let's just strip that apart and say, well, actually I'm deploying $1,000 a month to ETFs and I've got a holiday fund going on over here and I've got emergency buffers here. Right, now let's bring that home and say, right, this is how much yield you're going to get on this type of property at this price. Now let's understand what you're comfortable with some buffers in place, 2 weeks of vacancy, repairs and maintenance, figures, etc.
Yeah, great. Do your figures for you, not what someone else says.
That's right. Yeah, absolutely. But yeah, the running costs are a lot less than they used to be probably 12 months ago, Rach, because we're probably 4 rate cuts since then.
Yes. Yeah. Hoping for another soon.
You want another one? Yeah, okay. We might just get that before the end of the year. Who knows?
I think these next two questions could be answered in one.
Could they?
Yeah.
All right. Ebony and Kiva. The first home guarantee scheme, how much has it made an impact, and the trends and momentum in each market? 2 words, red hot. What are you seeing in lending?
Yeah, look, it's red hot. So just for some context, so my team in the month of September, which was our last full month, we're in the end of October now. So for September, that was our biggest month that we've ever had in 12 years of business, but it was actually 50% up on the month before.
Wow.
So
in actual loans written?
In applications, number of applications.
Yeah.
So, and that is a testament not only to what's happening in the market for us, we're not an anomaly. That's across every lender and broker, everyone's very busy, and it's because of that FOMO.
Yeah.
And it is coming in, and we can feel it red and hot, it's coming in thick and hot, that people want to get in.
Yeah.
Yes, there's the people that can qualify for the scheme, but they're not the only people moving. The people moving are people wanting to upsize their home because they're going, oh, my house is in first home buyer territory. This is my time to get that bigger house or near the beach, or investors. So everyone's moving at the same time. And that's what we're seeing. What are you seeing that happen to the market as a result of that, John?
Yeah, I think, and I've been saying it to our team, in my experience, I haven't seen 95% of markets around the country that we're buying in being all red hot at the same time.
Yeah.
There's usually like 1 or 2 that are maybe overheated, but that's all. Now we're seeing all of them pretty much. So if you're an investor out there wanting to invest, absolutely there's still some great opportunity, but just understand the markets that you're buying in and the mindset you need to have when you're going in there, saying, okay, once I get comfortable with my price and what my strategy is, and I know what I'm going to be getting for my money, I see it today, I'll buy it tomorrow.
Yeah.
I don't see it today and buy it in 7 days because it's well gone.
Yeah.
So that's the mindset you've got to have, and understand your own risk profile on that. But yeah, it's look, it will slow. And there's not signs of it, but I think unemployment will be an interesting indicator to check. So it is up, and if it continues to go up, I think we might see a little bit of change.
Yeah.
Markets that have been inferior in the past will go back to being inferior, is my thoughts.
Yeah. And so be mindful of what you're buying. Especially in these FOMO times.
Because you mentioned FOMO, and it is real, isn't it? Is making sure you're not just buying for the sake of buying, but buying in good quality areas, good quality product that's going to stand the test of time and not be volatile.
Yeah. Shannon asks, how to go from 1 investment property to 2 without using cash for a deposit?
Equity?
Shannon, you never need cash for a deposit. If you've got 1 property and you want to buy the second, you just need to have the sufficient equity in that property to be able to do it. So if you buy a property today and it's worth $600,000 and you borrow $500,000 on it, it doesn't mean you've instantly got equity to go again. But if you bought that property for $600 and now it's worth $800 and you still owe $500, well, you've certainly got the equity in there to go and buy again.
Yeah. Okay. So you read my mind, Rach. You said 600. I wrote down 600 at that same time. So let's do a quick example, Shannon. We bought something for 500 and we put down a 10% cash deposit. Let's say we put down 20%.
Yeah.
So we owe 400. It went up to 600. So now we go back to the banks and say, right, 80% of 600 is 480. Minus our loan of 400, we now have 80K of equity to go and buy our second property.
Yep.
Right, so that might be 10% deposit on a 500K property, 50 grand plus stamps, 25. We're using 75 grand plus conveyancing and building and pest, etc. There's our 80K that we used. None of our own cash. We will need cash to maybe hold the running costs each month, especially in the initial stages, but yeah, that's 101 in real estate, isn't it?
It is. And just one thing I'm going to say on that note is that some people and some clients that we saw this month and last month are looking to buy not right now, but they're getting great valuation, so they're getting that equity out now with the anticipation of when they want to buy down the track.
Yeah, because again, most listeners might already know this, but I'll say it again, is once you get equity out, you don't have to use it. It can sit there for the next 10 years. They don't have to touch it. You won't pay interest on it until you actually draw it down. So get it out while the going's good.
Yeah.
And then have options up your sleeve.
And if I look at cycles of the past and some investors of mine that have done quite well out of cycles, it has been when they've borrowed a little bit of money when the market's high, and then when the market goes down, they're ready to jump.
Ready to go again. Yeah, timing. They're timing the market.
Timing
Gee,
the
that's
market.
risky, isn't it?
Well, it's not risky if you aren't paying for that cash.
No, but it's risky from the point of view of I'm trying to time the market. I'm predicting that it's coming down for me to buy.
And you don't know when it's if or when.
Or when, yeah, correct. Just back on Shannon's example there, dollar value, notice that 400K was my loan at the start, and it's still the loan when I go to get equity out. So that means my loan has been
Interest only.
Interest only, which again might be a new phenomenon for a lot of people because they might get told to pay principal and interest on their investment properties, but that does absorb cash from their life that they might want to put towards lifestyle, principal place of residence, etc.
Yeah, very good.
Have a think about that because the interest rate's not that different really, is it? Like what, 0.2?
Not at all. And
Not
if
even.
you're not
Yeah.
paying for it, then it doesn't matter. If it's
Someone
in
else
offset.
is paying for it. It's like being a child.
Now, we've only got time for one more very quick one, and you don't have it because it came through
Ooh.
after we set this show up. It came through this morning. Max says, exit strategies other than boring, pay off loans in 30 years and live off rental income, or sell half, pay off remaining and live off rent. How can the use of equity from investment properties be accessible to invest in liquid assets that allow for flexibility? What after the PPOR is fully recycled? If the preference is to hold the investment properties, ride out the growth over decades, how do I use the equity from investment properties and the PAYG income supported by rent and distributions from ETFs, along with tax refunds, to build a sustainable portfolio generating revenue? John, I bet you get this question every single day.
That's a lot. That's an episode in itself, to be honest. But
we could probably jump back and do a big one.
We probably can do that, but I'll just quickly give it a go.
Yeah.
I think paying down our principal place is great, and that's definitely a target, but don't get obsessed with it.
Yeah.
Right? Pay the principal and interest, excess cash in the offset, equity out of our principal place to go and buy investments, right? Keep cash flow positive in terms of I'm saving more than I'm actually spending each month, and let the portfolio grow over time. Now, when we call that transition to retirement or lifestyle phase, you've just got to get that balance of how many assets am I keeping that's going to allow the portfolio to run itself, as in the tenant's paying for the running costs of the whole property, and for me to draw an income in retirement or lifestyle phase through superannuation, through shares, through any sort of 1 or 2 days a week income, or even some income through property. It's just got to be a gradual balance. Check in on that every 12 months and live your life. I think too many people focus too heavily on paying down their home, which we're told to do, great Aussie dream, and then pay it down. But we lose sight of the opportunity costs that can go missing because we're not looking at what's actually available to us at the time in terms of lending and borrowing.
Yeah, I think there's a lot of people that link them in together where they really don't need to be linked. You can pay your mortgage at whatever rate you want to pay. And, I don't set my repayments at a 30-year term. I set mine at a much shorter term. I have no intent of a 30-year mortgage. However, it doesn't affect my strategy of what I'm doing outside of my mortgage, which is investing in other things.
Yeah.
And they shouldn't. I just think people lump them together where they should be separate.
Yeah, absolutely. The good and bad debt is separate for a start, but also the mindset of it as well.
Yeah.
And you're choosing maybe a 15, 20-year term over a 30-year term, which means your repayments are going to be higher. The next person might not be able to afford that, so they might continue to keep it out at a 30-year and be comfortable with that.
But if I could choose a 15-year loan term and not invest, or a 30-year loan term and invest, I would choose a 30-year and invest every day.
I agree, totally. And remember, 30 years is not 30 years.
It's not.
Right?
No one does it.
So you don't wake up at age 50 and say, oh, I'll be 80 by the time I pay it off. No, you won't, because you're going to do some strategic investing that allows you to pay it down quicker.
Yeah. Yeah, and there is a little bit of patience that's needed with those strategies too. I think people are investing now and going, why do these people have these massive portfolios? Like, they've got to wait for the first lot to grow.
Correct, yeah, and more so than ever now, because they've seen what's happened in the last 4 or 5 years, right? So they're like, oh, I'll expect those results for the next 30 years.
Yeah.
Not going to happen.
Yeah. So what would your advice be to Mac? Do everything.
Do everything I just mentioned there, I think. But yeah, you run your race. Don't compare it to someone else's.
Yeah.
Right.
Amazing.
Yeah.
Excellent. Well,
stuff.
I'm looking at the clock. We have covered all of those questions. Thank you for sending those in, everybody. That's great. Make sure you check us out on YouTube and share this episode if you think somebody else might benefit for it.
Yeah.
You've been listening to John and Rach. This is Property, and we'll see you next week.
Bye.
Any information given in this podcast is for entertainment purposes only, and you should seek your own property advice before acting on anything you may hear in this podcast. If you want to start or advance your property education journey, John Pidgeon's book, Sort Your Property Out and Build Your Future, is available where all good books are sold, or via the link in the podcast show notes. Opinions or comments from any guests on the podcast are theirs and not those of the hosts, the publisher, or their respective license holders.